Welcome to Bloomberg ETF IQ. I'm Scarlett Fu.
And I'm Katie Greifeld. And Scarlett, we're halfway through earnings season and the Fed behind us for now.
Yes, but Jay Powell, give us a lot to think about here. I mean, the pivot's in place, but when is there going to be a rate cut?
Jerome Powell and the Fed, they're one in the same. Let's get to the biggest stories right now in the more than $10 trillion global ETF industry. And as we were just talking about, with a March Fed rate cut now unlikely, Treasuries lost and deepen as strong data reinforces Chair Powell's message.
Plus, it's been less than 1 month since spot Bitcoin ETFs began trading, and already some are seeking ways to boost their profitability.
And with New York Community Bank and regional lenders under pressure, we'll speak to DoubleLine's Morris Chen about his commercial mortgage real estate ETF. But before we get there, as always, Eric Balchunas from Bloomberg Intelligence here with us now, looking at the flows. Eric, what do you got?
Katie, Scarlett, thank you very much. Gotta say, the flows are a little boring. There's not a ton going on. I think because the markets are so ready for the Fed to cut rates, everything's just, if it ain't broke, don't fix it, right? So we see money piling into the same old cheap beta ETFs, IVV, VTI, VOO, AGG, right? This is a lot of 60-40 flows. The two Bitcoin ETFs, obviously that story continues to be interesting, and they continue to rake in money. Them hanging on that list is impressive. I guess if there was something that's shifting around, it's in the bond world, right? If you look, IUSB is on there. You've also got HYG, and then you've got at the bottom SPIB and LQD. That's 4 corporate bond ETFs in the top 20. That's rare. We didn't see that last year. It was all treasuries last year, right? That's interesting. Let's look at the outflows, and you're going to see a bomb out of SPY. This is, again, probably part of the tax loss harvesting, all that money that came in December. Not really sentiment-driven, more operational, but it's got to be about done. I think going into the next few weeks, SPY should be back to normal. A lot of money out of bill. You like to see that. That's short-term treasuries. And IWM, this was supposed to be a small cap year, not really happening, and GBTC continues to bleed. Let's hone in on this corporate versus treasury situation here, because this, to me, is one of the big things that's different this year. Look at all the orange line here is money into treasuries. These are gigantic numbers. This is 10, 15 billion, right? Record year last year. And corporates didn't do much, right? And then boom, right when that nice CPI, the inflation print came out that was pretty good, we thought, okay, the Fed's done hiking, maybe they'll even cut. Everybody was like, economics, the economy looks good. Let's go into corporates. We feel safer going in there. And they're done with treasuries. So on a dime, the past 3 or 4 months have just been money piling into corporates. So not a lot on the equity front. But on the bond front, there's some shaking up going on.
Yeah, absolutely. A sea change underway there, Eric. Thank you. And joining our conversation now, I'm thrilled to say we have Joanna Gallegos. She is co-founder of BondBloxx, which, of course, is all about fixed income ETFs. And let's start right there. This real pile that we're seeing out of Treasury ETFs into corporate ETFs. What is driving that?
Well, I think people are finally recognizing the resiliency that's in the U.S. economy and trusting it a little bit more. So they're starting to pivot out of their money market positions, their treasury positions. Yields are at historic highs, over 13-year highs. We really like the corporate space. We just launched 3 products in the corporate space last week. We're really encouraging investors to take a look.
And the products that you launch in the corporate space are all BBB corporates.
Right.
Why BBB as opposed to AAA?
We like to say it's the best part of investment grade to invest in, and that's because it has persistently outperformed the broader category in U.S. corporates, and as well it has higher coupon rates. So we think that without taking on any incremental default risk in investment grade, which is really low, it's only 20 basis points across the category, and then of course 20 basis points in BBB, you should be taking advantage of the sweet spot in investment grade and really optimize your exposure there.
In terms of the curve itself, if you look at your funds flows, your company's fund flows, there's a lot of money that came out of your XONE, which is the 1 year.
X1, yeah.
X1, sorry.
Yeah.
We haven't nicknamed it yet, but I'll go with that. Okay. And then you see money going to X10 and it's XHLF. That's people moving from the short end into the midterm of the curve. So is there a duration rotation underway as well?
Absolutely. I mean, people are sort of stepping out. They're going into the belly of the curve first. We did see some trades all the way out into 20 in the beginning of the year and in the end of the year. So I think people are starting to do what we've been talking about, which is like really be precise about the way you're adding duration exposure in your portfolio, and also consider credit exposure. We've been talking about credit all through 2023 because of elevated yields and how they cushion and support a total return in fixed income that we haven't seen in 15 years. And so we're very, very constructive, positive on credit and even high yield credit as well.
And apparently a lot of investors are too as well. Again, you go back to those flows, but I want to talk a little bit more about the duration rotation. I'm actually going to add that to my vocal warm-up. That is very hard to say. I feel like the best example of that last year was TLT. Of course, that's an iShares product, but it took in almost $25 billion, of course, and that was as it was going down and down and down. How much of a daredevil do you have to be to step into duration right now, to go really long out the curve, not just to go into the intermediate?
Yeah, I think that obviously last year people got a little bit burned by that trade by the end of 2023 into the third and the fourth quarter. The important thing is the exposure and the precision of the exposure. And the way we feel about it at BondBloxx is you should be able to have the choice to go back up the curve and then down the curve. And so, like as Eric said, we're seeing people incrementally go and take on duration. The BBB products also give you a duration play because we've cut them up by maturity cuts. So you could do BBB in 1 to 5, BBB in 5 to 10, then BBB in 10 plus. So really it's about toggling duration and credit within these choices and having more ability to do that. If you're a daredevil, I think that's the beauty of these products and ETFs, and the beauty of what's happening in fixed income product development in ETFs right now is there's just so much more choice for you to actually, realize what's going on in these markets every day. That wasn't the case a few years ago. You didn't have precision tools like this.
You talk about toggling duration. How much movement in and out of these different ETFs, whether it's BBS, BBBI, BBBL, is there? Or are people going in and kind of staying there for a couple of weeks at a time?
Yeah, they're brand new. So like we're going to start testing exactly how people are going to be using them, but we expect them to use them exactly how they're using our other products at BondBloxx, where they maybe start off in one part of the product set and then they move into the other product set as they need to.
Okay, you know what I'm going to bring up, right?
Yeah.
The wild child known as XCCC. So this holds all CCC rated junk bonds. The next most junky ETF holds like 25%. So this is like way out there.
Yeah.
Now that the economy is better and we feel like these companies may not default, rates go down, why not go here now? I know that was the excuse for people we asked earlier. It yields 14%. It seems to have held up so far. It just seems like I'm surprised this doesn't get more takers given the need for hot sauce in portfolios lately.
Yeah, not only that, I mean, it was the best performing category in fixed income last year. We talked a ton about it last year because what we were trying to call attention to people and investors was that these historic yields are really supporting products that have additional volatility in a way that you can move into them. We're not saying that it's something, like you call it hot sauce. We're not saying it's not a core allocation. It's something that if you are in a broad-based credit fund or a broad-based ag product, you might want to toggle this up, or even the high-yield product. You want to toggle with this. You want to add some of it to improve your outcome. But it's really hard to ignore those yields and that performance, especially if you have another year like 2023.
And before we let you go, just quickly, I mean, you're talking about these products and the way they're used, and it sounds very active, that they're used to facilitate very active portfolios. Who is the BondBloxx investor? Who's using your products?
So these were designed for professional investors, but they're also designed for the ETF investor, which can be anybody that kind of approaches their portfolio with more tactical precision. People have been doing this in equities for a very long time. They hold a core position in equities, and then they maybe add some sector exposure. They have so many choices to do that in the equity space. So we just would say, the ETF investor, obviously institutional investors like registered investment advisors and bigger pension funds understand how to use these tools in a more active way. But anybody can probably relate to the idea that fixed income markets are different now. They're structurally changed. Yields are at all-time highs, plus the yields seem to be persistent for now. And so you have these choices where you can really pick your spots, as we like to say at BondBloxx, and enhance your portfolio in a way you couldn't before.
Well, it's always great to see you. Really appreciate you taking the time. Of course, that is Joanna Gallegos of BondBloxx. Now coming up, it's been less than a month since spot Bitcoin ETFs have started to trade, and issuers are looking to boost their own profitability. We'll discuss next. This is ETF IQ on Bloomberg. Welcome back to Bloomberg ETF IQ. I'm Katie Greifeld. Time now for the ETF brief, where I walk you through the trends and the stories that caught my eye in the ETF industry. And we start in China, and we start with all the money coming out of China. This is really interesting data from Bloomberg finding that Chinese investors are actually sending a lot of money outside of China to the tune of $2 billion. Of course, it's not just really worried about foreign investors coming into China, it's also capital coming out of China. So definitely an important story, which we will continue to watch. But let's talk about Vanguard. Vanguard, it's known for its pretty trim lineup, especially when compared to the likes of BlackRock. But they are launching some new ETFs. You're taking a look at two muni ETFs that launched last week from Vanguard. One is an intermediate term muni ETF. The other is a California muni ETF. So pretty interesting move by Vanguard there. And let's talk about the opposite of munis, and that's Bitcoin, because it's been about a month since those, or less than a month, since the spot Bitcoin ETFs launched. You take a look at the flows so far. No surprise, you have BlackRock out in front, taking in nearly $3 billion into IBIT. Fidelity not too far behind, taking in $2.6 billion. So those are your clear leaders, Scarlett. But as Eric likes to say, there is a strong middle class there as well.
Absolutely. So many different issuers, right? Let's talk more about this issue with Bloomberg crypto reporter Olga Karif. Olga, you've written a story recently about how Bitcoin ETF issuers like Valkyrie are now retaining second custodians to safeguard customer assets. What is the thinking behind doing this?
So officially, a lot of the issuers are talking with sort of potential secondary custodians, alternatives to Coinbase, because they want to diversify their exposure risk. But I think there is a second motivation there, which is to reduce the fees that they potentially would have to pay to custodians. Currently, a lot of the spot Bitcoin ETFs are not charging fees initially. And of course, they have to pay for custody. It's not sort of officially known how much they pay for custody, but it's somewhere from sort of single digit basis points to 50 basis points, depending on the size of the client. This is what typically companies pay for custody. And if they have several custody providers, potentially they could later on pressure them on custody fees.
And this is so interesting because, I mean, on this program, we've been talking about for the past month how low the fees charged to investors are. It makes sense that issuers, of course, on the other end of that would want to lower their own costs as well to try to turn a profit here. So let's name some names, though, because we know that Coinbase is really prominent when it comes to Bitcoin ETF custodians. What other options do these issuers have?
Sure. So among the options are BitGo, which is the secondary custodian that Valkyrie picked. Then there is Gemini Custody. Kraken is relaunching sort of its custody solution. And so, and there are many, many others. There are lots of options out there. And, you know, all of these companies say that they're in talks with spot Bitcoin ETF issuers. So I think we'll see more announcements in the coming days.
All right. And we should note as well that Coinbase's CFO has said that even as Bitcoin ETF issuers add secondary custodians, they expect the firm to retain a significant portion of the assets. Olga Karif of Bloomberg News, who covers crypto for us, thank you so much. Now, still ahead on ETF IQ, shares of New York Community Bank resuming their sell-off, reflecting concerns about commercial real estate. Next, we speak to DoubleLine about its ETF tracking that industry. This is ETF IQ on Bloomberg. This is Bloomberg ETF IQ. I'm Scarlett Fu, along with Katie Greifeld.
And Eric Balchunas from Bloomberg Intelligence, back with us now for today's drill down, where we focus on one ETF. Eric, take it away.
Katie, today we're looking at a very specific part of the bond market. DCRE is the ticker. It's the DoubleLine Commercial Real Estate ETF, tracks commercial mortgage-backed securities. It's actively managed. DoubleLine known for that, not a shocker, right? The fee's pretty low for active, 39 basis points, and it's been out, almost a year. It's got $100 million already, which is pretty good for such a niche strategy here. Let's look at a cross-section of the bonds. Basically, this thing is looking through this part of the bond market for highly rated, mostly AAA rated bonds. So the safer stuff within this. So you can see it's all mortgage, U.S., and you can see the commercial MBS here. But down here is what's of interest. Look, almost 60% AAA very high level there. And also the duration is pretty low. Most of it's between 0 and 3 years. Let's look at the returns. Since it's been out, I threw MBS in there, which is the iShares mortgage-backed security, and AGG, which is the general ag. And look, this thing is up 6%. But it's not just up 6% with these other returning nothing. Look at the path. I mean, that is a nice low vol, 6% versus these guys. So that's going to be a high Sharpe ratio there. So between the low fee, the high return, low vol, I'm not surprised this thing has gathered $100 million already, Katie.
All right, Eric, thank you so much. And joining us now to talk about this ETF is Morris Chen, who, of course, manages the fund for DoubleLine. And Morris, it's great to have you with us when we think about the events of the past week. Of course, New York Community Bank really reigniting fears about commercial real estate and whether there are more shoes to drop there. Can you separate out the noise from the reality for us?
Yeah, as I kind of looking at this environment, it almost feels like a little bit of a deja vu, and I can see why the market's thinking that way. However, just pointing into the earnings call in terms of the transcript for New York Community Bank, it really feels idiosyncratic, and that's what myself as well as a few research analysts I've spoken to have parsed out. And the number one reason is largely due to one component. They took on signature bank loan assets that increase and put them into a different categorization. And as a result of that, they had to increase reserves. And then number two, with respect to New York Community Bank, what they're doing in terms of their loan book, they've lent a lot and primarily focused in that regional-centric New York-oriented market, particularly in the multifamily space. If you just look at their loan book, it's very, very heavy and heavily centers around rent-regulated commercial real estate loans on the multifamily side. And from my take on it in itself, 2019 was a year where the New York State passed significant headwinds or produced significant headwinds in terms of rent regulations, and that impacted a lot of the commercial real estate prices in terms of multifamily. So to me, those two reasons contributed to some of the anxiety of NYCB.
Right, that makes total sense, the specifics as it relates to NYCB. When you look at the big picture, the specter of commercial real estate has been hanging over our heads for almost a year now, but we've seen that transaction volume has been fairly light and not a whole lot of marking to market. Valuations not exactly up to date either. How is this changing now that the Fed has indicated it's done with raising rates?
Well, the end of the rate hiking cycle will introduce more transparency. And what I mean by that, you've removed half of the equation, at least in terms of uncertainty, meaning how high will rates go. So at least you have capped on that higher upper range in terms of rates. Now, the flip side in itself is, to me, as you kind of look at transactions, you're going to see borrowers and as well as lenders, as well as buyers and sellers of buildings being able to transact in a much more efficient way with less uncertainty. And that will bring forth more transparency. It is my belief, as we're looking out in the environment, that increased transactions will likely increase transparency in terms of valuation. To me, any deal or any properties that were to be transacted today, particularly from a valuation standpoint, I do think you're going to see a bottoming process start to form in the next couple of months. And that's largely because as transactions come out, as these values are blasted in the media prints and covered, whether values are down by 30, 40, 50, 60%, it's going to bring forth attention. And the glass half full side is that's marketing for commercial real estate, meaning a lot of dry powder on the sidelines are going to look at this and bolster their confidence to step back into the market.
And looking at your portfolio, one thing that strikes out to me is that how few bonds are in it. You got 140 bonds in here. Bond ETFs famously have a ton of bonds. Like MBS has 10,000 bonds in it, right? So this is very narrow. I got to ask you, how does a bond get into that? It seems like a very selective process. Can you go over that?
Yeah, I mean, as we're looking at the commercial mortgage-backed securities environment, there are varying degrees and varying different types of subsectors within commercial mortgage bonds. As we're parsing through, number one, we're focused on minimizing credit risk as much as possible. And number two, kind of looking at the portfolio makeup in terms of duration, in terms of what areas we want to focus, and what part of the yield curve we want to triangulate. But at the end of the day, through active management, as you've seen in terms of our performance, we've performed thus far. I do think this market, particularly in the last 12 months, has benefited from some of that baby out with the bathwater dynamic. I think going forward, you'll likely continue to see some type of some form of that as well, especially with these headlines again popping up since we last spoke.
Right. Well, in your notes looking forward, you point out that you expect lenders and opportunistic buyers to step in. Can you give us a description of who exactly you're expecting to step in when it comes into the buyer? Are we talking about distressed debt investors or someone else?
I think there's two parts. I think the commercial mortgage-backed securities market will take market share back from banks, meaning as this market continues to normalize, as investor demand picks up for investments on the fixed income side, the CMBS market will turn around or turn on, meaning issuance will increase. So more loan availability coming from the CMBS market. And then the second component is the private credit market. We do think, at least with respect to private pools of capital being raised, similar to what's observed in the corporate credit market, on the commercial side, you'll likely see this become a robust opportunity for bank disintermediation plays, as well as looking forward in terms of the commercial real estate maturity wall, the need for private capital to come back into the space. And that all begets with more transparency. You need more transparency. You'll need to see valuations and believe those valuations are accurate. And I think again, we're just starting that process, and we'll look at this over the next couple of months.
All right, Morris, really glad we could get your perspective on today's show. Of course, that is Morris Chen of DoubleLine, who manages DCRE. And before we wrap up the show, we just wanted to mention the retirement of State Street Global Advisors Sue Thompson. She leads ETF distribution in the Americas. She's planning to step away in the second quarter of this year. Now, when it comes to State Street, the firm's ETFs assets have doubled to $1.2 trillion during her nearly 6-year tenure. And Eric, we actually won't be here next week because we're going to Miami.
Yeah, good time of year to go to Miami.
Absolutely.
Yeah. Big ETF event.
We'll be at the Exchange Conference. We'll be bringing you coverage from that. But that does it for this edition of Bloomberg ETF IQ. I'm Katie Greifeld along with Scarlett Fu and Eric Balchunas, and this is Bloomberg.